Two of the most enterprise-driven digital asset networks on the planet just made a move that slipped under almost everyone's radar. If you weren't paying close attention, you likely missed it. We're talking about XRP and Hedera. These are not meme tokens. They were never designed for short-lived speculation or social media hype cycles. From the beginning, both were engineered with institutions in mind: banks, corporations, governments, and global infrastructure players. What just happened between them isn't a flashy press release filled with vague promises. It isn't one of those strategic partnerships that disappear half a year later. This is deeper than that. It's technical alignment. It's real interoperability. It's foundational infrastructure. And when two serious enterprise-grade networks decide to connect instead of compete, you have to wonder what conversations are happening behind closed doors. Let's slow this down. Most crypto projects are obsessed with dominance. They aim to become the single chain that replaces all others. But that's not how the real world functions. Banks use multiple systems. Corporations rely on specialized software for different tasks. Governments diversify their infrastructure. They don't depend on one rail for everything. They build ecosystems where tools communicate with one another. That's where this becomes significant. XRP, developed by Ripple, was built to move value efficiently across borders. It focuses on liquidity, settlement speed, and cost reduction. It has been tested for years in financial environments and is optimized for payments. Hedera, on the other hand, approaches the market from a different angle. It was created for enterprise applications such as supply chains, tokenization, digital identity, and data integrity. It runs on hashgraph technology rather than a traditional blockchain model. Its consensus mechanism emphasizes fairness, speed, and high throughput. Different strengths, different architectures. Now connected. That alone sends a signal. Instead of fighting over who wins, they are creating a structure where both can operate within the same framework. When enterprise-focused networks invest time and engineering effort into interoperability, it usually means there is real demand pushing it forward. Large corporations don't allocate resources toward integration unless they anticipate practical use. Picture a multinational firm tokenizing real-world assets, commodities, property, environmental credits. They may use Hedera for governance and efficient asset issuance. But when those assets need instant cross-border settlement, a payments-focused network like XRP becomes relevant. Without interoperability, the company would have to sacrifice performance somewhere. And major corporations prefer optimal solutions, not compromises. This is not about hype cycles. It's about infrastructure. Infrastructure rarely trends online, but it quietly reshapes systems over time. For years, the crypto industry operated in silos. Bitcoin developed its own narrative. Ethereum expanded its ecosystem. New chains created isolated environments. Innovation flourished, but friction remained. Institutions entering the space do not want to be locked into a single ecosystem. They want flexibility and options. What this integration suggests is maturity. The conversation is shifting from, is blockchain viable, to how do we deploy it effectively at scale? Timing matters here. Institutional interest in digital assets is stronger than ever. Spot Bitcoin ETFs exist. Major asset managers have blockchain divisions. Regulatory frameworks in several regions are becoming clearer. The debate is no longer about legitimacy. It's about execution. Both XRP and Hedera have endured criticism. XRP navigated prolonged regulatory disputes. Hedera faced questions about governance structure and decentralization. Yet both continued building, quietly, methodically. Now they are aligning. Still, caution is important. Cross-network bridges in crypto have historically introduced complexity and risk. Security vulnerabilities have emerged in other ecosystems. Interoperability alone does not guarantee usage. The true test will be deployment. Will enterprises actually run workflows across both networks? Will central bank digital currency pilots consider multi-chain architectures? Will global supply chain platforms integrate settlement layers powered by XRP? That's where theory meets reality. This move appears different because it connects enterprise ecosystems, not just public chains. Hedera's governance council includes major global corporations. These are established multinational players, not small startups. Their involvement signals that real-world use cases are being evaluated. Technically, Hedera's hashgraph consensus achieves rapid finality and high throughput. XRP's ledger is optimized for liquidity movement and payment certainty. Combine enterprise-grade tokenization capabilities with efficient cross-border settlement, and you approach a full-stack solution. It's not guaranteed success. Adoption takes time. Regulation evolves. Markets shift unpredictably. But this reflects progress, from experimentation toward implementation. Crypto culture often celebrates noise, sudden price spikes, viral stories, influencer narratives. Institutions operate differently. They build slowly and deliberately. When you observe infrastructure being developed instead of marketing campaigns, that deserves attention. Rather than trying to eliminate each other, XRP and Hedera seem to be expanding collective capability. That reflects strategic maturity. Central banks worldwide are exploring digital currency models. Some prioritize governance structures. Others focus on interoperability. A flexible, multi-chain framework may align better with policy-driven environments than a single dominant chain. Nothing here guarantees immediate price movement. It does not confirm ultimate victory. What it demonstrates is long-term positioning. The future of blockchain may not belong to one network. It may belong to interconnected systems, specialized platforms communicating through shared rails, cooperation instead of zero-sum competition, engineering instead of marketing spin. The bigger insight is not about short-term charts. It's about infrastructure being constructed layer by layer. So consider this. Are you focused solely on volatility, or are you watching the architecture of the next financial framework take shape? Because hype fades quickly. Infrastructure persists. If real enterprise deployment emerges from this alignment, it could represent the foundation of a broader institutional multi-chain environment. But remain informed, remain skeptical. Always conduct your own research. The crypto industry evolves rapidly, yet structural change often unfolds quietly. Sometimes the most transformative developments arrive without fireworks, just careful engineering decisions that gradually alter the landscape. The next stage of digital assets will not be defined by noise. It will be defined by utility. Now let's go even deeper into what this actually represents. Because when two enterprise-grade networks connect, the surface explanation is never the full story. The real implications sit underneath the technical layer. Interoperability between XRP and Hedera is not just about moving tokens from one chain to another. It's about aligning two fundamentally different architectures in a way that expands enterprise capability. That distinction matters. Hedera's hashgraph consensus offers rapid finality and high throughput with predictable costs. It was built for environments where performance and governance structure are critical. That's why major global corporations participate in its council. They're not there for speculation. They're there because they see operational use cases. The XRP ledger, meanwhile, is optimized for liquidity and cross-border settlement. It was designed to move value efficiently between jurisdictions, currencies, and financial systems. It focuses on speed, cost reduction, and certainty of settlement. Three elements financial institutions prioritize above everything else. Individually, each network, solve, is a specific problem. Together, they start to resemble a layered infrastructure model. Think about how the internet evolved. No single protocol does everything. Email runs differently than streaming services. Cloud infrastructure differs from payment gateways. Yet everything connects. The power comes from interoperability, not monopoly. The same logic applies here. If enterprises can issue tokenized assets or manage real-time data workflows on Hedera while leveraging XRP's liquidity rails for global settlement, they are no longer forced to choose between ecosystems. They gain optionality, and optionality reduces risk. For institutions, reducing risk is often more important than chasing innovation. This is where the market dynamic shifts. For years, crypto narratives centered around which chain will dominate. But institutional adoption rarely works that way. Large financial systems are modular. They prefer specialized components that integrate cleanly rather than one all-encompassing solution. That's what makes this development strategically significant. It hints at a world where enterprise blockchain is not winner-takes-all, but network of networks. And that model aligns more closely with how global finance already operates. Now consider regulatory evolution. Clarity around digital assets has been slowly improving in multiple jurisdictions. Financial regulators are no longer asking whether blockchain will exist. They're asking how it can fit within compliance frameworks. When regulation matures, infrastructure becomes more important than speculation. Interoperable systems are easier to regulate than fragmented silos. They create traceability, auditability, and structured integration points. That appeals to policymakers. And then there's central bank experimentation. If enterprises can issue tokenized assets or manage real-time data workflows on Hedera while leveraging XRP's liquidity rails for global settlement, they are no longer forced to choose between ecosystems. They gain optionality, and optionality reduces risk. For institutions, reducing risk is often more important than chasing innovation. This is where the market dynamics shifts. For years, crypto narratives centered around which chain will dominate, but institutional adoption rarely works that way. Large financial systems are modular. They prefer specialized components that integrate cleanly rather than one all-encompassing solution. That's what makes this development strategically significant. CBDC research continues worldwide. Some central banks focus on governance models. Others emphasize transaction speed. Others prioritize cross-border settlement. No single public ledger currently satisfies every policy requirement. A multi-chain architecture offers flexibility. One network can handle issuance logic. Another can manage settlement efficiency. That layered approach mirrors existing financial systems, where different institutions perform specialized roles. Still, none of this guarantees immediate usage. Enterprise deployment cycles are slow. Integration testing takes time. Security audits are rigorous. Corporate decision-making is methodical. The absence of headlines doesn't mean nothing is happening. It often means evaluation is underway. And that brings us to competition. Ethereum continues building scaling layers. Traditional financial institutions experiment with private ledgers. Payment processors innovate internally. The blockchain space is crowded, but most competitors are still attempting to capture market share. XRP and Hedera, through interoperability, appear to be expanding the total addressable market instead of shrinking it. That's a subtle but powerful difference. When two specialized systems align, they're signaling that demand may be complex enough to require multiple solutions. And complexity is exactly what global finance is built upon. Of course, skepticism remains healthy. Cross-network integration increases technical complexity. Complexity introduces potential vulnerabilities. Security must remain airtight. Performance must remain consistent under load. Enterprises will not tolerate instability. So the ultimate question is not whether integration exists, it's whether production-level workflows emerge. Will real tokenized asset platforms route settlement through XRP rails? Will supply chain data systems anchor verification on Hedera while using XRP for liquidity bridging? Will financial institutions experiment with hybrid models combining both? Those are the indicators that matter. Zooming out even further, this move reflects a broader evolution in crypto culture. The industry is transitioning from noise to structure, from speculative excitement to engineered systems, from rapid launches to patient build-outs. Retail traders often chase volatility. Institutions build frameworks, and frameworks shape decades, not weeks. For holders and observers, the takeaway isn't a price target, it's perspective. If this integration matures into real enterprise usage, it reinforces the idea that blockchain's future is collaborative. Specialized rails communicating through interoperable bridges, governance models coexisting with liquidity layers, data integrity aligned with settlement efficiency. That is a far more durable vision than isolated ecosystems fighting for dominance. It also changes how you interpret market cycles. Short-term price swings may continue. Volatility will not disappear. Headlines will still dominate social media. But underneath that noise, infrastructure may quietly expand. And infrastructure compounds over time. The larger insight here is strategic positioning. Both networks are signaling long-term commitment to institutional relevance. They are building in anticipation of demand, not reacting to hype. Whether that demand materializes at scale remains to be seen, but the direction is clear. We are moving toward a multi-chain institutional environment, toward modular digital finance, toward systems that mirror the complexity of real-world economic activity. That's not guaranteed success. It's not an immediate catalyst, but it is a structural evolution. So the real question becomes, are you evaluating crypto based on daily price charts, or are you analyzing which networks are constructing the rails for tomorrow's financial infrastructure? Because speculation moves quickly, architecture moves carefully, and sometimes the most important transformations don't arrive with dramatic announcements. They unfold through deliberate engineering decisions that over time redefine how value moves across the world.